Morning to you all. It's been an extraordinary week, Paul. Absolutely extraordinary. Um, I'll go through it sort of methodically, and you'll have a pretty good idea then why it's all happened. But it's because a lot of people are on holiday, partly, so liquidity was quite a bit lower. We call it the sort of, I don't know, the A team, the key decision makers are off to on their vacation, and they put their underlings in charge, and it's quite a responsibility. And I know it although the key decision makers are kept in touch, but there's some big moves, and it was a bit of a perfect storm, Paul. Anyway, a very extraordinary week for the markets last week. They were gripped by fear of a major sell-off. Everyone looks at the screens, they looks at the VIX, they looked at all the major indices, and it really started with the poor Institute of Supply Management manufacturing data, and also a notable miss on the non-farm employment data the previous week. So looking at my calendar, we're on what week beginning the 12th. We have to go back to the week beginning the 29th. And if you just scroll down, if you remember, we had the non-farm employment data on the Friday. On the Thursday, we had this really bad manufacturing PMI. And I think that was the start of, things aren't looking. Morning to you, Gary, as well. Yeah, hi there. This is the start. It looks like it was the start of a bad run of data. And then on Friday, we got this horrendous non-farm employment change, 114,000 jobs. We were expecting 176,000. And the previous month's data was revised down by 27,000. So all in all, it was ghastly. Anyway, basically, it stoked fears of a significant slowdown in the US, and there was even talk of a recession. It's just weird how it was almost sort of Thursday morning, everything seemed fine. Then we got the ISM data. Then on the Friday, we got the poor non-farm data. But this also coincided with a rate hike in Japan. And this happened here. You can see the rate hike. They pushed rates up to 0.25% from 0.1%. Yeah, they are really that low. Anyway, this caused a bit of a chain reaction because the Japanese yen rallied by 5% the following week, and that caused a sharp sell-off in Japanese equities. Yeah, and the employment rate was 4.3. That's right, Paul. Yeah. Morning to you, Jonathan. Anyway, this, you can see it in the yen. We have a quick look at the dollar-yen rate. So this rapid decline in the yen, and it was just almost accelerating. And this was one of the key components of what happened. However, I'm going to explain it in some detail. By the end of last week, despite these massive moves that we saw that's Monday's candle for the S&P, for the Nasdaq, massive fall. These aren't the cash market. These are the 24-hour markets that are tracked by our data provider, which is the markets that you can trade them. As you know, you can trade them now, and the underlying market's not open, but it gives us a good idea about the sentiment. Anyway, there were some significant falls on Monday. We had that, the VIX index, the fear and greed index. It's sort of normally around 13, 12, 13, 14. It peaked at 65 on Monday morning. This is it here. So if I want to show you the last 3 months, that's what it did on Monday. Why is it not showing the... Yeah, it got a lot higher than... I think it won't show the data. I don't know how I can... Maybe I can look at advanced chart. Maybe that's what I need to look at. Gosh, it's not showing it now. But maybe this is not, maybe this in hours what it shows, but the VIX actually went to 65 last Monday, and that's its highest level since March 23, when the US small sort of mid-cap banking crisis occurred. Anyway, the moves in the market were exacerbated with many key decision makers, as I say, away. So that sort of had an effect on liquidity. What I mean by liquidity, not so many investors, traders, funds taking positions who are just sort of keeping things as is whilst everyone's on vacation. And that's the reason why I say to people, don't go on holiday in August, Paul. You do get some really big moves. And if you do get some major events, then those moves are even greater because of the problems with liquidity. Anyway, what caused the magnitude of this sell-off? I know that's what everyone's wondering. US data in the last week of July and the first few days of August, as I said, we've already discussed that. That alarmed investors, and they were expecting this sort of Goldilocks scenario. Goldilocks, not too hot, not too cold, where the oh, had to back for A-level results. Oh God, Paul, I just hated all of that GCSE and A-level results, and then you have degree results. It's like, yeah, not a great time. Well, not a great time for your kids either. There'll be a few crumpled fingernails. Anyway, this Goldilocks scenario is where the economy remains robust, but where price pressures continue to moderate. And that's what investors had taken on board. And this was going to allow the Fed to execute their first rate cut in September since the start of the pandemic in March 2020. However, the manufacturing and employment data was not received well. Investors immediately questioned actually whether the Fed should have cut rates at the end of July. If you remember, in this week, we had the FOMC decision the day before all this data came out. And you think, well, surely the Federal Reserve, with all their clever brains and statisticians, would have had their own take on what the manufacturing sector was doing, and also what the labor market was doing. And they do get sight. Or is it me? Lost you. Hello, can you hear me? Is everyone? Can you hear me, guys? I've got people saying they can't hear me. Hello, I'm back. Paul says I'm back. Did anyone else lose me? All good, says Gary. Fine, says Philip. Yeah, Paul, it might have been you. I'm hoping it's you. Don't wish to. All okay. Yeah, good. All right, Paul, it might have just been you. Anyway, so back to. Thank you so much, Josie. Thank you, Gerald. That's great. Anyway, back to what was happening at the end of July and the fact that the Federal Reserve surely should have cut rates in July at their July 31st meeting had they known about this. And I think that's it. There was a feeling that the Fed might be starting to get behind the curve. This is not able to control the markets. The markets are controlling the Fed, and I think this concern spread. Investors and traders speculated about the risk of the US entering a recession in the next 2 quarters, and I think Goldman Sachs actually came out and said that they had increased their risk rating of a US recession to 25%, which helped drive forward interest rate contracts lower. I mean, obviously, a 25% of a recession is not great, a great probability, but the fact that they increased it from 15 to 25% was notable. Anyway, when we look at the forward interest rate contracts, at one stage, okay, so currently interest rates in the US are 5.25% to 5.5%. They banned them, so it's a band between 5.25% to 5.5%. At one stage, this time last week, the probability of a 50 basis point cut, or 0.5% to you and me, the probability of a 0.5% cut was 75%. 75%. In fact, if you look here, yeah, it says 85%. But I know when I was looking at it sort of just before the opening of the US market is around, and I thought, gosh, 85% of a probability of a 0.5% cut. That's huge. Anyway, you can see it's moderated now, and there's a greater probability of just a 0.25 point cut. Well, that's now, but as I said then, early last week, during the intensity of the sell-off, that FedWatch tool implied a probability of 75 to 85% of that cut in September. Anyway, the sell-off in US equities, that was not the only story that contributed to the sudden global panic in the markets. We discussed the rapid appreciation in the Japanese yen. I mean, when I talk about the appreciation, this is the number of yen to the dollar. It was 162 plus, in early July. The yen strengthened so that at one stage last week, it went down to close to 140 yen to the dollar. So that is the yen rallying sharply, or the dollar falling against the yen very sharply. And this was driven by the surprise hike in interest rates by the Bank of Japan, and the belief that the central bank, the Bank of Japan, had effectively embarked on a tightening cycle. I mean, this is just weird because they had been continued to adopt an ultra loose monetary policy, while all the other central banks around the world, the major Western ones, were all tightening in the face of inflation. Record jump, the increase in inflation, the greatest increase you've seen in 40 years. Interest rates had to be pushed up and were pushed up sharply, but not in Japan. Anyway, they've now done it. Then they've done it partly because of the weakness in the Japanese yen and the potential for it to cause further price pressures in the Japanese economy. Anyway, economists, traders, believe that there are more rate hikes expected, and this drove the yen much higher, which in part was driven by the rapid unwinding of the Japanese yen carry trade, which many investors and hedge funds had used to such good effect. They use it to enhance their returns. And the risk of the carry trade is well known. And when the yen started to rally, it became self-reinforcing, as the rising yen caused more funds to cover their yen shorts, thus buying more yen. Anyway, just as a brief overview, because I know a couple of you have just asked this, the carry trade strategy used by hedge funds and investors involve borrowing in a low cost or a low yield currency like the Japanese yen. What I mean by the low yield, if you want to borrow sterling, you'd be paying 5.25%, 5.5%, 6%. In Japan, you were paying, well, as we've just been discussing, 0.1%, now 0.25%. It's nothing. It's nothing compared to what you have to pay to borrow dollars or sterling. So those hedge funds, those investors borrow yen. They then swap the yen for dollars, and they invest those dollars in high yield investments such as US technology sector and those magnificent 7 stocks that we've talked about in the past that have really done so well this year. In fact, over the last 20 odd months, certainly over the last 18 months. Therefore, the other main symptom of the yen carry trade unwind, aside from the rush to close the yen shorts, was the rush to close the other side of the trade, which were positions in these magnificent 7 equities. So the unwinding of the carry trade added to the burden of sellers exiting the technology shares, with the sentiment spreading quickly to the wider market. Following the bad non-farm employment and the bad manufacturing data. And last Monday, some commentators were also speculating that the Federal Reserve could cut rates without waiting for the next meeting. The next meeting is on 18th of September. I've been around long enough. I've been in this business for 40 years. And I have seen the Federal Reserve cutting rates unexpectedly outside of a meeting, it causes so much panic. And when I heard the rumors, I just thought there's not a chance. Imagine if the Federal Reserve cut rates without waiting for a meeting. Imagine what the market participants would think. Gosh, it must be really bad if the Fed are doing that. And they weren't going to do that, but it would have spread panic like you wouldn't believe. If you thought last Monday was bad, had the Fed come and cut rates in an extraordinary move, that would have just been the end of the markets. Anyway, the stress and sometimes panic of earlier last week gradually dissipated, and it really did actually culminate. I think we had a big day on Friday? The S&P, yeah, big day Friday. Big day Thursday, I apologize. Yeah, big day Thursday. And that was following the release of the better than expected weekly initial claims. Yeah, it's interesting. Sometimes innocuous data, and I would generally describe weekly initial claims as it's sort of the data that goes into making up the non-farm employment data, which is a monthly reading. So the weekly initial claims are part of that deal. But because the market was fretting over the employment market and whether that was suggesting that the US was going into recession, when we got a better than expected initial claims, so fewer claims for unemployment, expecting 241 came in at 233, you might look at that and think, really, Jerry, are you telling me, a data that was just 8,000 fewer claims resulted in that? I think some people were expecting worse. That was part of the problem. Anyway, I think, when you get one bad non-farm number, it is just that. One swallow doesn't make a summer. But for some reason, the markets just, joined in the panic when this all hit the news wires. But last week, yeah, the employment picture maybe is not as bad as some had feared. The Japanese equity market also recovered last week, as you can see here. That was a horrendous sell-off. The actual underlying index, and this tracks it over 24 hours, so it actually rebounded after the Nikkei shut, but the 225 that you can trade 24 hours, that actually rallied quite sharply. But on the day, the official Nikkei 225 closed down 13% last Monday. Its biggest ever one-day fall. I'm not sure whether yeah, I think it was its biggest ever one-day fall. Yeah, it was. Anyway, in the end, the Nikkei closed up on the week. Yeah, closed up. What my numbers here? I had about 400 points. This is where it settled the previous week. Yeah, it closed up 400 points, something like that. Anyway, that was a pretty turbulent time. Makes a good Netflix film. Paul, you joke. Yeah, but what was that film? The Big Short. That slightly tongue-in-cheek, but I thought fascinating because it really explained what all the collateralized debt obligations were and how it was just how Wall Street ignored it. Great film. So who knows? Yeah, I think this is probably not big enough to make a film out of, but you never know. You never know. Anyway, I think what we witnessed last week was a potential shift in prospects for the US and Japanese economies. I say potential because I think the worst is over. The storm lasted little more than a few days, but it is an example of the effects of deleveraging. Does anyone not know what deleveraging is? Deleveraging is where you reduce the magnitude of your trades, your positions in the market. And this is really investors gradually adjusting back to normality. What do I mean by normality? This is following the effects of the ultra low interest rates that every Western economy and Japan and major economy have used to combat the effects of the pandemic. Quantitative easing. we haven't seen the likes of those. The record low interest rates are just that. I'd never seen anything like them in my days. In fact, they were the lowest rates in the UK for 300 years, for God's sake. Anyway, the moves were likely made worse by the reduced liquidity, and it's typical in sort of late July and August that liquidity is like that. Will this happen again? More than likely, but it may take some time because you need to have certain conditions in place. These events usually sort of explode from a base of low volatility. And, when you look at volatility at the moment, this is a monthly chart. Yeah, there we go. Look, it's showing 65. Why wasn't it showing it early on? Anyway, volatility, what is it now? Well, it's 20.57. Yeah. It may take some time for volatility to really subside. With the volatility, the VIX now sort of comfortably below its peak, as I've just said, from a week ago, 20.5, that's still above the average. The average, if you look at it over a year, well, you may not know it, but the average over the last year is about 13 and a quarter, 13 and a half, not 20.5. So volatility is still heightened. Yeah, absolutely. Quickly onto the dollar. I hope that makes sense. I love the way, I know you're all listening, because when I said, can you still hear me? Gosh, there was a plethora of responses. So if you do want to ask any questions about the yen carry trade or your understanding, this was a perfect storm of events that independently happened in the US and in Japan. And in low liquidity, the moves were really, really magnified, I'd say. Anyway, onto the dollar, just very quickly. You can see the dollar. Paul, that's great. Well, at least you're up to date now. Yeah, you can then. When did the results come out? Is it on Thursday morning? Is it the A levels? Anyway, well, good luck with them. I wouldn't want to do that again. Gosh, the stress and anxiety. Anyway, sudden fall in the US dollar at the beginning of August. Do you remember the this fall here? That was following the poor unemployment data, and it was a reaction to the belief that the Fed would be making cuts of at least 1.25%, 1.5% by year end. And those forward interest rate contracts that we were looking at from the Fed Watch tool, they have definitely moderated over the past week. As we were looking at this here, it was, as I said, 75, 85% probability of a 0.5% cut in September. It's no longer that. Anyway, this sort of explains the gradual pickup, only slight, gradual pickup, modest pickup, I call that, in the US dollar last week. And I think, but with inflation data out later this week in the US, I think traders will have a much clearer picture by the end of this week as to what is going to happen with interest rates. Not definitely, but it's another important piece of the jigsaw as we build up to the next Fed meeting in about 40 days? 18th of September. Oil markets, yep, comments on those, up again today. We all know what's going on in the Middle East. We've seen the news, growing concerns of an escalation in this conflict between Israel and Hamas. And over the weekend, or was it last night, the Secretary of Defense, Austin, actually agreed to dispatch an aircraft carrier. I think this is an aircraft carrier or a battle group that's going to be replacing one that was due to be swapped over, but they're hurrying this other one out there, and also some sort of guided missile submarine. Anyway, it's there to bolster Israel's defense in the hope that this might dissuade Iran's proxies or even Iran from attacking Israel. Anyway, but that's oil up just over $2 last week. So, it'd been absolutely battered. I don't think the prospects for oil are great myself in the long term. In the short, medium term with the conflict in the Middle East, it's anyone's guess in a way. Okay, let's have a look at the calendar. It's, gosh, I'm so late, but I've been going. Paul, you wanted an explanation. I hope it's helped everyone else as well. So we start the week on the right day would help. Okay. Nothing out on Monday, but apparently I've Adrian, no problem. My first webinar Monday morning, an hour and a quarter late. My fault. You forgot. Tell you what, Adrian, this has been a really interesting webinar. I really suggest you get the recording and listen to, absolutely, you're quite right. You will be able to listen to the webinar recording. If you have any problems, call Shannon or Suresh on customer support and they will help you. But we record it all, you're quite right, and it'll be rendered and made available within an hour of the end of it, roughly. But yeah, you should listen to it. It's well, my bit, I would say it was quite interesting. It'd been a hell of a week. Anyway, Elon Musk, the owner of X, very odd. No problem, Adrian, no problem. He's interviewing Donald Trump. It's not really sort of the news I'd like to report because I don't think it is newsworthy, but it's worthwhile actually focusing on the presidential race because Kamala Harris seems to be gaining in some of the key battleground states. And also there's a poll over the weekend that said that she was more trusted on the economy than Trump. Certainly a lot better than Biden anyway. And also, I think that the Democratic Party's strategy they've been describing Trump and his team as weird, and it seems to have energized their base. It's just curious where you wouldn't expect a comment like weird. Well, they are weird for God's sake. I think the whole of the whole presidential race, potentially between two of the oldest candidates ever, is that the best that the US could come up with? It's just weird. Anyway, there is actually a proper debate between Trump and Harris on TV. I think it's ABC. That's on September the 10th. Anyway, we got to wait for a little while. Okay, in the UK on Tuesday we got unemployment data, the unemployment claimant count. We have moderating wage growth. It was sort of sticky for quite some time, and I think it's the service sector wage growth that the Bank of England's worried about. But we've got a slowing labour market. If the service sector can moderate as well, then it may well help the Bank of England cut by a further 0.5% by year end is what the forward markets are pricing in. But I'm not sure that a new Labour government will want to see the number of claimants rise like they did in the second quarter. Anyway, the data for July, we're expecting 14,500 new claims versus 32.3 in June. Average earnings expected at 4.6, so that is encouraging for the Bank of England, following an annualized rate of 5.7 in May. Yeah. Okay, core PPI. PPI is actually producer price index. That's the cost of goods going into production, sometimes referred to as factory gate prices. It's a precursor to inflation, and that's expected at plus 0.2%, which is pretty moderate, really. Nothing to worry about there if that's where it comes in. The dollar will be sensitive to anything greater than that, though. We then have the Reserve Bank of New Zealand, not something I normally comment on, but what's interesting is that Forex Factory saying no change, but I think there's a 70% probability of a rate cut of 0.25%. Anyway, whatever happens, just make sure if you've got any New Zealand pairs that you're aware of that announcement coming out on Wednesday morning. It'll be coming while you're asleep, unless you're so hot you're unable to sleep, in which case you can stare at your screen and watch it happen. But please just be careful of that. When we wake up on Wednesday morning at 7 o'clock, we've got the release of the CPI data. I always refer to it as CPI inflation. Some people say, is that the inflation data? Yeah, so I call it CPI inflation, but consumer price index. Expected at plus 2.3%. That's an annualized figure. Last at 2%, you can see in there. And you think, wow, so inflation's going up. This is, yeah, the way that annualized rates are calculated, they look back a year. A year, in July, we had CPI falling in July 23 by 0.4%. That now has fallen out of the equation. And so the sort of moving average of CPI will increase, not because prices are necessarily increasing, but because of the base effect. Anyway, the base effect has benefited the number on the way down, and now it's detracting from it slightly. But there is, energy prices are expected to increase in Q3 and Q4, possibly. That's what they're saying. So there might be more pressure on inflation, but 2.3% is the figure we're expecting for UK inflation. We then have core CPI. So they actually discriminate between headline and core. We don't, but in the US, they've got the core CPI. That is the data that removes the volatile components of food and energy. And you might think, well, hang on a second, they're the important bits. They are. That's what drove inflation higher in the first place, and they've come off. But by removing them, we'll know what the underlying inflation rate is, and that's why we focus on the core CPI rate, plus 0.2% month on month, with an annualized rate, and it's not showing here, but the annualized rate at 3.3%. The US dollar and US assets, so all the NASDAQ, S&P, Dow, and if you do trade US bonds, which we don't, but treasuries will be particularly sensitive to that as well. Thursday morning, we have some data out from China, industrial production and retail sales. Okay, yeah, we're getting someone's reporting sound. I won't stop for now. I think that might be some people's connection. Maybe it is something to do with GoToWebinar. Anyway, industrial production and retail sales in China. China's recovery a little bit patchy. Retail sales are continuing to struggle, as you can see here. Well, actually, it's pick up, but they have continued to struggle, and that's because the consumers aren't particularly happy in China. Does it affect our markets? Yeah, it does. With the Chinese economy not really firing on all cylinders, it doesn't help some of these multinationals that are listed in the US and the UK. Retail sales out as well on Thursday. Core retail sales we exclude the transportation items, which sort of distort it a little bit too much. Volatile trend in retail sales, really. US consumers still fretting over inflation in the economy, really, and that does affect how much they spend on purchases. And then in the afternoon, later on in the afternoon, we've got the two readings on the manufacturing sector in the US, the Philadelphia region in New York State, also two great manufacturing bases. I think the manufacturing sector, of course, took countrywide, it took a bit of a dip, didn't it, when we saw that ISM manufacturing data. Mixed data expected, with a pullback in the Philly index expected, but just not doing well in the manufacturing sector, I'm afraid. And that's one of the sort of pointers that some economists picked up on, and some traders speculated about the US entering a recession. But yeah, so that data out 1:30 at the same time as retail sales. Friday, we have retail sales here in the UK. A rebound from last month's horrendous reading of -1.2, plus 0.6% for July is what is the forecast. And the whole year's data has really been blighted by seasonal factors. And that's really down to the weather, as I think you all know. Who was buying summer clothes in May and June? It was shocking. Umbrellas, yes. Sou'westers, yes. Waterproofs, yes. Not t-shirts, shorts, and polo shirts, and whatever. Anyway, that seems to have sort of unwound a little bit. I, for one, was told by my wife to go and buy some ruddy summer wear. I duly did, just to keep her happy, apart from anything else. And then one of the readings I like to follow, this is the first reading of the UOM, stands for University of Michigan. They put out a great survey on consumer sentiment that is closely followed. Why on earth it only attracts a medium impact, I'm not sure. 66.7%. Yeah, the sort of sentiments continues to, it's basically been waning ever since the start of the year. And I think partly because at the start of the year, we were all expecting 7 interest rates cuts from the Federal Reserve. But yeah, they're more worried about inflation and whether there will be enough cuts to get them spending again. Anyway, there we go. That sort of completes the end of the week. Half half nine. That's a long one. I do apologize. You have been attentive, and I know because when the sound's gone, you're clearly not asleep. Thank you very much for attending. I hope it's all been helpful. Any other questions? Very happy taking any of them, unless you find it so inclusive that it's answered all your questions. Fascinating markets. Just keep applying the rules. That's the most important thing. Even in volatile markets with massive stops, you still only risk the same bank. Just reduces your stake size. Yeah. All the best. Yeah, no problem, Paul. Good luck with the A levels. All the best, everyone, and catch you again next Monday.